This video is not a detailed introduction to the book 100 Baggers, Stocks That Return 100 to 1 and How to Find Them, or a review. This video is a revisit to the book and trying to use my own analysis and valuation framework to help you understand those 100 baggers. In this video, I am also trying to take a look at how some of those winners have been doing since the book was published and update the list with some recent laureates. In the last part of the video, I try to provide some candidates for the next 100 bagger based on my model. If you have not read this book, please spend some time on it and you will find that it deserves your time. Okay, let's start with what the book is about. 100 Baggers, Stocks That Return 100 to 1 and How to Find Them is a book written by Chris Mayer, an experienced investment analyst and writer. The book was first published in 2015. The book is based on the concept of 100 baggers, which refers to stocks that have increased in value by 100 times or more. Mayer sets out to identify the common characteristics of these high-performing stocks and to provide insights into how investors can identify them early in their growth cycle. Mayer draws on extensive research and analysis of historical data to identify common themes and patterns among past 100 bagger stocks. He explores the importance of factors such as small market capitalization, high return on equity, and low debt-to-equity ratios, among others. The book is organized into four main parts. The first part provides an overview of the concept of 100 baggers and introduces Mayer's research methodology. The second part presents case studies of several 100 bagger stocks. The third part discusses the specific characteristics of 100 bagger stocks and offers practical advice for investors seeking to identify them. The fourth and final part offers Mayer's perspective on the broader implications of the 100 bagger phenomenon and the future of investing. One of the main takeaways from the book is that investing in 100 bagger stocks requires patience, discipline, and a long-term mindset. Mayer emphasizes the importance of avoiding the temptation to sell too early and instead allowing winners to continue to compound over time. The book also highlights the potential for significant returns for those who are able to identify and invest in 100 bagger stocks early in their growth cycle. Overall, 100 Baggers is a valuable resource for investors looking to identify high-growth stocks with the potential for significant returns. Readers have found the book helpful because it provides actionable advice and guidance on how to identify high-growth stocks with the potential to become 100 baggers. The insights provided by Mayer are grounded in extensive historical research, which gives readers confidence in the approach and methodology he recommends. So the next obvious question is, what can we learn from the book? The book is well researched and draws on extensive historical data to identify common characteristics among past 100 bagger stocks. Let's take a close look at those statistical characteristics that are common among 100 bagger stocks. These include small market capitalization. Many 100 bagger stocks start out as small companies with a market capitalization of less than $1 billion. High return on equity or ROE. 100 bagger stocks tend to have a consistently high ROE, which indicates that they are generating strong profits relative to their equity. Low debt-to-equity ratio. 100 bagger stocks tend to have a low debt-to-equity ratio, which indicates that they have a relatively low level of debt compared to their equity. High revenue growth. Many 100 bagger stocks experience rapid revenue growth over a period of several years. Consistent earnings growth. 100 bagger stocks tend to have consistent earnings growth over a period of several years. I am going to spend some words on some of those items. First, about small market capitalization. Here are the author's own words from a recent post about it by mentioning Nvidia, back in 2013. More important point is that market cap, $7.7 billion. That ain't small. And this gets to something I would do differently if I wrote my book 100 Baggers today. I wouldn't write that today. It's obvious that you can't expect to buy Apple today and get 100 times. Size plays into the mix. But I'd be less dogmatic about it. Yes, you should prefer smaller companies, but the more important factor is to focus on the rate at which the business compounds its capital. As the other factors are all about the financial characteristics of a company, I would like to simplify them into two metrics that could help an investor better understand the source of continuous compounding. The two metrics are revenue growth and free cash flow. The reason for revenue growth, which has been covered in my previous videos from time to time, is that once again, according to this research by Morgan Stanley, 74% of profits from holding a stock for more than 10 years comes from the growth in revenue. This is also mentioned in the book by stating that a long runway for growth is extremely important for a potential 100-bagger. If a company could be able to maintain a 25% growth in its revenue, averagely speaking, even without the help of valuation multiple, its value could be 100-folded in 21 years. Another one is free cash flow. By definition, free cash flow is the cash flow provided by a company's core business subtracted by the cash flow for the investment. Positive cash flow at an appropriate percentage of revenue, like 10%, alongside rapid growth in revenue demonstrates that a company is able to keep reinvesting in its core business to keep it growing at a desirable pace while staying in a healthy and self-financed financial condition. Put in another way, as long as a company is growing its revenue at around 25% meanwhile generating free cash flow of more than 10% of its revenue, the company is a candidate for a multiple bagger in the long run. One big takeaway here is that this model doesn't require a high ROE, low debt ratio, or consistent earning growth because a consistently positive and rich free cash flow solves all these problems. As long as those two metrics could be bolstered, sooner or later, all profitability metrics will catch up and eventually, a company would evolve into one with a one-digit revenue growth rate and abundant free cash flow. This is what has happened to some 100-bagger laureates, and we are going to revisit some winners later on. By the way, some of you might be wondering why studying the past has a meaningful and pragmatic indication for the future. There is a piece of research by Credit Suisse in 2013 that proved wonderful companies remain wonderful. This phenomenon can also be watched when we revisit some of the 100 baggers right away. I may cover this topic in a later video. Please leave your comments if you are interested in it. How are some of the winners doing recently? Chris Mayer provides detailed case studies of several companies that have achieved 100-bagger status. Some of the companies covered in the book include American Tower Corporation, AMT. A real estate investment trust, REIT, that owns and operates wireless communication towers. It has been still growing its revenue by 10% to 20% annually and becomes a cash cow. Monster Beverage Corporation, MNST. A company that produces and markets energy drinks and other beverages. It is not just a beverage monster, but also a compounding monster. Ross Stores Incorporated, Rost. An off-price retailer that offers discounted clothing and home goods. It obviously has slowed down to a mature company with modest growth but is resourceful in its cash flow. Edwards Lifesciences Corporation, EW. A medical device company that specializes in heart valves and related technologies. Another perfect example of a consistently wonderful company. IBM Incorporated, IBM. A multinational technology company that provides hardware, software, and services for a variety of industries, with a particular focus on enterprise and business solutions. Inability to catch up with the state-of-the-art technology evolution, IBM has become a mediocre company with at most flat revenue. Fortunately, it has a handful of cash inflow to bolster its stock price from falling. Electronic Arts Incorporated, EA. Is a multinational video game company that develops, publishes, and distributes interactive entertainment software and content. It was and is still a great company, but the valuation multiple inflation before 2018 drained the power and the stock price has remained flat ever since. And etc. Many of them provide an impressive exhibition of the argument by Warren Buffett that wonderful companies remain wonderful. As seen from their charts, a great number of them achieved another multiple folded even after they became 100 baggers. As an update to the list in the book, a couple of companies would be briefly introduced as the recent laureates of 100 baggers. The first one is NVIDIA, also mentioned by Chris Mayer in his recent post. After 2010, NVIDIA's fortunes began to turn around as it shifted its focus from making graphics processing units, GPUs, for personal computers to developing GPUs for other industries, such as gaming consoles, data centers, autonomous vehicles, and now AI, which helped the company to become one of the most valuable semiconductor companies in the world. As you can tell from the chart, both revenue growth and multiple expansion helped 100-folded, and the company's free cash flow has been consistently staying at roughly 20% of its revenue. Shopify is an e-commerce platform that enables small businesses and entrepreneurs to create and manage their own online stores. The company has experienced rapid growth since its founding, with its revenue and user base expanding significantly and its market capitalization increasing to become one of the most valuable e-commerce companies in the world. Its appreciation of company value was driven evenly by the enormous revenue growth and P/S ratio inflation. In the early years, its free cash flow was even negative, but the company managed to turn it around and achieved 100-fold with its high-pitched growth and healthy cash flow. The story of Tesla's becoming a 100-bagger is a little bit more dramatic because its business was so volatile in the years after it went public, and its free cash flow had been staying negative since then for a few years due to the heavy gigafactory buildup, making its stock price stagnant during the same period. But in 2019, the company eventually gained a positive free cash flow and thus propelled its stock price to skyrocket. A guess for future laureates. Any assertion about a potential 100-bagger is premature and arbitrary, but it is the investment that a decision has to be made far before you know it is the correct one. Here is some speculation about the 100-bagger candidates. These stocks are not recommendations but just serve an informative purpose. Please use your own discretion and do your own homework before investing. The first is Copart, a company that provides online vehicle auction and remarketing services to automotive dealers, vehicle dismantlers, and insurance companies. This one comes directly from Chris Mayer himself, but he refused to be confident that this one will definitely become a 100-bagger in any given period of time. That's a wise choice, though. You can tell from the chart, a nice grower and compounder. 10 times P/S ratio with a gross margin of 40% and a revenue growth rate of less than 20% seems a little bit overpriced. The following two are: Shockwave Medical, SWAV, is a medical device company that develops and markets innovative treatments for complex cardiovascular disorders, using intravascular lithotripsy, IVL, technology. And Technoglass, TGLS, is a Colombian company that specializes in the design, manufacturing, and distribution of architectural glass, windows, and aluminum products for the construction industry. Both companies are based on my own research, and I am also making my disclaimer that they are not guaranteed to become 100-baggers, and I am not responsible for any consequences of an investment based on the information provided here. With that being said, I have briefly covered those two companies in the previous videos. Please check those videos if you are interested. And in the following videos, I might spend some time analyzing and evaluating those companies in detail. Please let me know in the comments if you support this idea.